right, good morning. So I'd just like to echo what Scott McCarty mentioned, thanking all of you for being here, the first responders, elected officials, local board members, but also I'd like to acknowledge the PSPRS staff putting all of this together. This has been many months coming together and organizing, so I think they did a great job pulling this all together. So thank you to the staff that put all that effort in. I'd like to go into just a little more detail that Scott McCarty covered about kind of where we are, what's happening, the progress that we're making. And this goes back, Scott was talking about, if you look at it 10 years ago, things have really changed. And the biggest change, I think, was on the legislative and the court side. The pension reforms, 2011 through 2018, getting those significant changes in place so that the unfunded liabilities didn't just continue to grow. There were challenges with the court cases and then additional pension reforms, and so that the dust all kind of settled out in 2018 with the creation of Tier 3. And so that's kind of what we had to deal with going forward. Some of the things that Scott talked about, the changes that we're making in terms of conservative actuarial assumptions. How are we doing this to manage it going forward, to continue those reforms, to continue to get the plans funded? The last 3 years, we have really focused on aggressive employer outreach about pensions, educating staff, elected officials. We created a new position. Clark Partridge is in that position to help educate employers. Over the past 3 years, Clark and I have done more than 200 presentations around the state to employers to really explain and walk people through this. And so that's an offer that's out there. If anyone would like to have that for your employer, you can contact us and we can get things scheduled. We can do it virtually, we can do it in person, however we want to set it up, whether it's a board or a council, whether it's individual staff members, whatever you think you need. Also, in the past 3 years, the management team, a very new management team, a lot of new staff. We hired 3 years ago new actuaries, new auditors, and so it is very different. And the results over the past several years are really increasing the public safety corrections officer plan funding levels, decreasing those contributions that Scott was talking about. So there have been a lot of employers that have taken advantage of that we've worked with to make those changes. And really what that leads to is that greater pension security for retirees and members, taxpayer savings in terms of those contribution rates, and really, as we're going forward over the next few years, our focus is to maintain that path forward. And really the question we're getting from employers is, if we put this money in, how can we be sure that it's not just going to happen again and go back to the way it was? And that's what we're working with the board on, is get the structure, the policies in place so that we're not going to go back, that it will continue to get better funded as we go forward over the years. The additional employer contributions, Scott mentioned the $5 billion over the past few years. Just this last year was almost $3 billion. The largest one coming from the state, a little over $1 billion. And then the remaining from all the other employers around the state. Some of those were debt financing, so it's important to remember, even though they paid down their pension liability, there's still other debt that may be on the books that took care of that. And so they're all taking care of that through their budgeting process. Over the past couple of years, Scott mentioned, this is a lot of progress for this system from where it was a few years ago. It's, we kind of lose sight of that when we live it every day. So it's nice to know that this system is actually being recognized nationally. We just found out pension and investments for 2 years in a row, the largest asset growth of any of the top 1,000 pensions in the country from all of those additional contributions. And then also the other thing to look at, the additional contributions impact the funded status. So that's one measure. The other measure is looking at the annually required contributions. In NASRA, the National Association of State Retirement Administrators, looked at our additional contributions. And above what was annually required, we received 225% of total contributions. So our employers are putting double in what they're required to do each year. Which is actually more impressive, because there's actually some states where they don't even meet the annually required contributions. So to actually double that is pretty impressive. This is just I like to look at this graph. I mentioned that the trend on here, look at the U shape. The left side was pre-pension reform. where the funded status was going down. In the middle, 2016, the pension reform. So doing that stopped digging the hole. It stopped making the unfunded liabilities bigger. And then you can see the progress on the right side with the policy changes that we're making, with the additional contributions going up, that 65% on an aggregate basis. The corrections plan it's a similar trend. Again, the three pieces, the pre-pension reform, pension reform, and then the right side of that plan is we're working with employers in changing our funding policies. That one is even better funded. You can see 83%. Very significant increase. One of the other challenges we have, the elected officials plan, is still, you can see less than 33% funded. So in today's dollars, what has been earned in benefits, we only have 33% of the money we need to pay those benefits going forward. There's a lot of things that make this plan a little bit different. It's not every individual employer. This is a one pooled plan. All the employers pay the same contribution rate. This plan operates similar to ASRS. And one of the things that happened, if you go back in time, that big drop, 2013, 2014, the legislature put in place a fixed contribution for employers. So they were not contributing what was actuarially required. And then that changed in 2018. So all the employers had their contributions increase. We're getting that back on path, and I know our legislative update will include some information. There's a plan at the legislature to get this plan funded, whether it's in 1 year or over the next 3 to 5 years. They have a plan to help get this one improved also. And this is kind of the opposite U shape. If you look at the blue and the orange, that's the CORP and the PSPRS. These are the contribution rates. So you can see on the right side, they're starting to taper off and go down on an aggregate basis. That gray line is the elected officials, and that's the one that continues to go up. And so that's the one that we're working on right now at the legislature, try to get that one better funded. The system progress, we ended last year from an actuarial basis on their valuations, the investment returns were minus 4%. Nobody likes to see a negative, but we did better than the markets did overall. We outperformed the benchmark in our peer plans, mostly due to the asset allocation to alternative assets. And the thing to remember is the year prior to that, the investment return was 27%. So you're not going to have positive returns every single year. So after a 27, you could expect to see a bit of a downturn. And remember, pensions are a long-term strategy. So it's a lot of years together. Don't look at 1 or 2 years to try to determine where are we. It's where are we going and what's that long-term strategy. And I know Mark Steed and Harry Papp are going to go into some detail on the investment side about what that means. This is just a visual on those investment returns. Again, if you look at the last couple of years, you can see that one high one at 27 and then the minus. So you can see the volatility over time. That volatility is expected. It's going to happen in the markets. It's a normal part of the economic cycle. So with the additional contributions that all the employers have put in, it's given us some opportunities about how we rebalance, look at the asset allocations, and we're really well positioned going forward for the next 10 years. The updated funding policy, I always like to remind everyone, the actuarial liabilities, they're a present value. So we look at all of those future payments that are going to be paid out, whether it's an active member or retired member, and discount those back to a present value. So each year, those total liabilities are discounted one less year, which means they're going to increase each year. So those numbers are going to continue to change. So understand how that impacts your contributions where you are. We want the assets to grow at the same pace as the liabilities are growing. And remember that's an actual benefit. It's a debt. So that benefit is a formula in statute. It's going to be paid out. However, it's estimated. We don't know how long these people are going to work. What's their compensation going to be when they retire? How long are they going to draw that benefit in retirement? Do they have a survivor? How long are they going to draw benefit? So, we're doing our best guess at estimating these, but they're going to change as we go forward. So we're going to update those every year. And just realize reality is that the pensions are a moving target. They're just estimates going forward. And a plan that's 100% funded is 100% funded today. It doesn't mean you're 100% funded a year from now. And so even if you do have put in additional contributions, got your plan funded, it's something that does need to be managed every year. Just because you get to 100% doesn't mean you're done. We have to manage it every year going forward. And with that, that's all I have. I think we'll get together later today if there's more questions. But for now, I'd like to introduce Doug Cole and Diane McAllister with a legislative update.